Right now in America, there's a number more powerful than your salary. It decides your mortgage rate, your car payment, your apartment application, even some job offers. And most people think there's only one way to move it: pay off debt. That's false. The average American FICO score sits at 714. That figure dropped for the first time since 2013, and almost none of it happened because people borrowed more money. It happened because of things that have nothing to do with your balance. In the next few minutes, you'll see exactly which 4 levers move your score, starting today without paying a cent toward what you owe.
Here's what almost nobody explains correctly. The credit score formula isn't one number. It's 5 stacked on top of each other, and only one of them is about how much you owe. Payment history alone makes up 35% of your FICO score. That's whether you paid on time, not whether you paid it off. The amount you owe relative to your limits is worth 30%. Length of history is 15%. New credit inquiries and credit mix split the remaining 20%. That means over 2/3 of your score is decided by factors that have nothing to do with your debt shrinking. But here's the part that changes everything. Most of these factors can be manipulated legally, ethically, and immediately, while your balance stays exactly where it is. The second biggest factor in your score isn't your debt, it's your utilization ratio, the percentage of your available credit you're currently using. If your credit limit is $10,000 and you owe $750, you're using 7.5% of your line. But if your limit is only $1,000 and you owe the same $750, you're using 75%. Same debt, wildly different score impact. This is the part nobody tells you. You don't need to pay down the $750 to fix that. You can request a credit limit increase on an existing card. If it's approved, your utilization ratio drops instantly. Same debt, same dollar amount owed, but a completely different percentage feeding into the formula. Consumers who keep utilization below 10% can see a boost of 10 to 50 points compared to higher ratios. And that's true whether the low utilization comes from paying debt down or from the limit going up. But raising your limit is only half of this lever. There's a second move, and it's one almost nobody uses correctly. Age itself isn't a factor the scoring formula sees directly, but the length of your credit history is worth 15% of your score, and that's harder to fake. Except there's one legitimate exception. Being added as an authorized user on someone else's older, well-managed credit card can import that account's history, length included, onto your own report. If a parent or spouse has a card open since 2008 with a spotless payment record, and you get added as an authorized user, that account's age and track record can start counting toward your file. You don't touch your own debt. You don't open a new loan. You just inherit years of positive history overnight. This is exactly the kind of move responsible for something else in the data. Gen Z and younger borrowers are closing the credit score gap with older generations faster than any previous generation did at the same age, largely through tools like this one, not through debt payoff.
Here's a number that should stop you. In a federal study, 1 in 5 consumers had a confirmed error on at least one of their 3 credit reports. Errors that were serious enough that correcting them changed the person's actual score. That means roughly 10 million people are paying higher interest rates right now, not because of their real financial behavior, but because of a clerical mistake sitting on a report they've never looked at. This is where it gets interesting. The same federal study found that correcting these errors led to real score changes for a meaningful share of consumers, and some saw their risk tier improve enough to qualify for better loan terms without paying down a single balance. The process is simple and free. Pull your reports from all 3 bureaus, look for accounts that aren't yours, balances that are wrong, late payments that were actually on time, or old debts that should have aged off. File a dispute directly with the bureau. By law, they have to investigate. If an error gets removed, your utilization or payment history factor can shift immediately, again, with $0 sent towards your actual debt. Most people never check. The bureaus are not going to volunteer their own mistakes to you. But even error correction has a limit. There's a fourth lever that catches almost everyone off guard because it works in the opposite direction most people expect. You'd think closing an old unused credit card would clean up your file. It does the opposite, and understanding why is the key to the next move. Closing an old credit card reduces your total available credit, which can push your utilization ratio up. And if it's your oldest account, it can shorten your credit history too. Both outcomes typically lower your score. So the move here isn't an action, it's an inaction. Keep the old card open. Use it for one small recurring charge, like a streaming subscription set to autopay. That keeps the account active, keeps your history intact, and keeps your available credit counted in the utilization formula, all without carrying a balance or paying interest. There's also a myth sitting right next to this one that actively hurts people. Carrying a small balance month to month does not help your score. FICO has confirmed this directly. Paying your statement in full every month protects your utilization while costing you zero interest. The idea that you need to look active by carrying debt is not just false, it's expensive. Stack these four levers together: a higher limit, an authorized user account, a corrected report, and an old account kept alive, and you're touching every major factor in the formula except one: your actual balance. That's the part almost nobody explains, because pay off your debt is easier content to make than understand the mechanics of the formula that's actually scoring you. So here's where this leaves you. The number that shapes your mortgage rate, your rent approval, your car loan, it was never only about how much you owe. It's about how the system reads your behavior. 4 moves, $0 toward debt, and most Americans have never made a single one of them. But there's a catch to all of this that we haven't touched yet, because raising your limit and adding an authorized user both trigger something on the lender side that can just as easily work against you if you do it in the wrong order. That's a different mechanism entirely, and it's the reason some people try these exact tactics and watch their score drop instead of rise. That's where we're going next.